Something unusual is happening beneath the surface of the global economy. Gold is rising again, but the reaction from serious investors is not excitement. It is caution. They are watching quietly as money shifts from paper promises into hard assets. And when capital moves silently, it usually means confidence somewhere else is fading. Is this recovery a simple market bounce, or a signal that currencies, bonds, and global trust are entering a new phase? If the reasons for buying are compounding, then what risk is the world slowly preparing for? And why are institutions acting before the public even notices? Welcome to Boring Currency Index, where markets are studied calmly, not chased emotionally. If you have been observing the economy longer than most fast-moving headlines, consider subscribing and becoming part of this quiet circle of analysis. And tell them in the comments, where are they watching this from today? Which country? Which city? Because every perspective adds another layer to the global picture. The recovery in gold began without loud celebrations. Analysts noticed that prices were moving higher, but the tone of the market felt different. Instead of excitement, there was a sense of careful observation. They believed the rise was not just about profit, but about protection. When investors returned to gold after a period of selling, it suggested that deeper concerns were shaping decisions. Market observers explained that gold's strength did not start overnight. The current cycle grew after geopolitical tensions changed how governments viewed safety. When foreign reserves were frozen during global conflicts, many central banks realized that traditional assets might not always remain neutral. Gold regained importance because it did not belong to any single nation. Large institutions watched these changes closely. They saw that central banks were quietly increasing their reserves, creating a steady foundation under the market. Even when prices pulled back, structural buyers remained active. This behavior signaled that gold was no longer treated only as a speculative trade, but as a strategic reserve. For business leaders, the message was subtle but important. Commodity movements often reflect deeper economic stress. Rising gold prices can point toward uncertainty in currencies, trade systems, and long-term financial stability. Entrepreneurs who study these signals may better prepare for shifts in exchange rates and global demand. Investor psychology also began to change. Instead of reacting to daily news, many funds focused on long-term risk. They believed that ongoing liquidity support and rising debt levels could slowly reduce purchasing power. Gold became a quiet indicator of how seriously institutions viewed these challenges. By the end of the week, analysts agreed that the recovery was more than a technical rebound. The reasons for buying were still present, and according to many observers, they were slowly compounding beneath the surface of the global economy. As the gold market stabilized, analysts turned their attention away from short-term price charts and toward a deeper structural change. They observed that the biggest buyers were no longer retail investors or small hedge funds. Instead, central banks had quietly become the dominant force behind demand. This shift changed the way professionals interpreted every movement in the gold price. The turning point began when global financial tensions reshaped how governments viewed reserves. For decades, many countries believed that holding foreign currency assets guaranteed safety. But after geopolitical events challenged that belief, policymakers started looking for assets that could not be frozen or restricted by another nation. Gold, which exists outside any single financial system, suddenly appeared more reliable. China's role in the global gold market just became incredibly important, and here's why you should pay attention. Facing serious economic headwinds at home, like rising debt and a shaky property market, Chinese authorities made a huge strategic pivot. They started stockpiling massive amounts of gold while letting their own currency weaken against it. Analysts believe this is a genius move to protect national wealth and maintain flexibility in global trade. The sheer scale of their buying spree caught everyone by surprise, signaling a major shift in how countries manage their reserves, and they're not alone. Other emerging economies are now following suit, diversifying away from relying on a single dominant currency. This creates a powerful, steady demand for gold that isn't swayed by daily market drama. For investors, this means gold now has a strong structural support level. Thanks for watching, and don't forget to subscribe for more insights. Ever wonder why gold seems to be making a huge comeback? It's not just because it's shiny. There's a big economic shift happening called the debasement trade. So what is it? Simply put, debasement is when a currency, like the dollar, loses its purchasing power. This happens when governments print more money to cover their debts, which can lead to inflation. As the value of money goes down, smart businesses and investors look for safe places to store their wealth. And historically, that safe haven has always been gold. It's a real tangible asset that can't just be printed out of thin air. This growing concern about currency debasement is a major reason we're seeing gold prices rise. It's a classic move to protect wealth in uncertain economic times. Want to learn more about smart investing? Make sure to follow for more insights. As the global economy moved deeper into uncertainty, analysts noticed a pattern that was less visible on the surface. The rise in gold was not only about central banks or geopolitical tension, It was also about liquidity, the steady flow of money entering financial markets through policy decisions. Governments continued to prioritize growth and debt stability, and this created a wave of capital searching for safer ground. They observed that when liquidity increases, investors often take more risk at first. But over time, experienced institutions begin to question the long-term value of currencies and bonds. This psychological shift was subtle but powerful. Instead of chasing fast profits, many large funds started moving quietly into assets that could hold value during periods of monetary expansion. Portfolio managers explained that traditional hedges were losing some of their effectiveness. Bonds, which had historically protected wealth during market stress, were becoming less reliable when inflation remained elevated. As a result, investors began to rethink the balance between paper assets and tangible stores of value. Gold benefited from this transition because it carried no credit risk and required no trust in government policy. At the same time, exchange-traded funds linked to gold saw steady inflows. Analysts describe this as a sign that institutional sentiment was shifting. Rather than reacting to daily price swings, investors were preparing for a longer phase of economic adjustment. They believed that fiscal dominance, where governments focus more on managing debt than controlling inflation, would continue shaping financial conditions. The psychological dimension of the market became just as important as economic data. Investors who had previously ignored gold began to reconsider its role in a diversified portfolio. They were not necessarily predicting a crisis, but they were acknowledging that uncertainty had become a permanent feature of the global system. This change in mindset reinforced demand even during periods of short-term volatility. Geopolitical fragmentation added another layer to the story. Trade tensions and shifting alliances created a world where financial systems were less connected than before. Analysts argued that in such an environment, neutral assets gain value because they do not rely on a single political structure. Gold AS appeal grew not only because of inflation fears, but also because it represented independence from competing economic blocs. For entrepreneurs and business leaders, the lesson was clear. Market psychology often changes before official policies do. When institutions adjust their portfolios, they signal expectations about future risks. Companies that monitor these shifts can better prepare for changes in borrowing costs, investment flows, and currency stability. Observers also noted how retail investors began following institutional behavior. As headlines discussed liquidity injections and monetary easing, smaller investors sought ways to protect savings. This created a reinforcing cycle. Institutional demand encouraged retail participation, and retail demand added momentum to the broader trend. By the end of this phase, analysts concluded that gold's rise was driven as much by perception as by policy. Liquidity waves were reshaping investor psychology, pushing capital toward assets seen as stable and neutral. The market was no longer reacting only to immediate news. It was responding to a deeper realization that the financial environment itself was changing, slowly but steadily beneath the surface. As gold continued to hold its ground, analysts around the world began releasing forecasts that revealed a wide range of expectations. Some banks predicted that prices could climb to new historic highs, while others urged caution. This disagreement did not confuse professional investors. Instead, it highlighted how uncertain the global economic environment had become. Several major institutions projected that gold could move toward levels once considered unrealistic. They studied past bull cycles and compared them with current conditions, noting similarities in liquidity growth and geopolitical stress. Their analysis suggested that if the pattern continued, the price could rise significantly in the coming years. However, not all experts agreed with such optimistic projections. Some warned that rapid gains often come with periods of volatility and sharp corrections. Observers noticed that the debate itself carried an important message. When analysts struggle to form a unified outlook, it usually reflects deeper structural change rather than a normal market phase. Investors were no longer focusing only on inflation or interest rates. They were examining how trade tensions, currency diversification, and fiscal policy could reshape the financial system over the long term. Mining companies and export-driven economies also entered the spotlight. Australia, one of the world's largest gold producers, experienced rising export values and expanding production plans. Analysts explained that higher prices encouraged companies to upgrade operations and invest in new projects. Share prices of major mining firms climbed sharply, reflecting investor confidence in the sector's future profitability. Yet experienced economists warn that booming commodity prices do not always signal economic strength. Sometimes they indicate instability elsewhere in the system. When investors move heavily into hard assets, they may be preparing for slower growth or increased currency risk. For business leaders, this created a strategic dilemma. On one hand, high commodity prices offered opportunities for expansion and investment. On the other, they hinted at underlying volatility that could disrupt long-term planning. Entrepreneurs studying the situation began to ask practical questions. Should companies increase exposure to real assets? Should they diversify revenue streams to protect against currency swings? Analysts emphasized that there was no single answer. Instead, they encouraged decision makers to focus on resilience, building strategies that could withstand multiple economic scenarios. Forecasts from major banks range from moderate growth targets to extremely bullish predictions. Some expected gold to rise gradually as central banks continued accumulating reserves. Others believed that continued rate cuts and geopolitical pressure could accelerate demand even faster. Despite these differences, most experts agreed on one key point. The reasons supporting gold had not disappeared. As the market moved forward, observers described gold as a mirror reflecting global uncertainty. It was not simply an investment trend. It was a signal of how institutions viewed risk, currency stability, and the future of financial systems. For the business community and young entrepreneurs watching closely, the lesson was clear. Understanding gold, ICE's trajectory was not only about predicting prices, it was about recognizing the deeper economic shifts shaping the world we're in this financial landscape.